Players in the pension and insurance sector are offering to help the government settle its pending bills running into billions of shillings. This through a public-private partnership arrangement, and the arrangement would involve investing their pool of resources in government debt as they await payment from the government upon agreed terms. Jimmy Mbogo now takes a look on this proposal and how the government and suppliers would benefit from the arrangement, which will help provide alternate capital for the government away from debt and increased taxation.
The pending bill menace continues to put constraints on government's expenditure, with the pending bill verification committee pointing out that the government owes contractors and suppliers at least 110 billion shillings. It is this debt that now presents an opportunity for players in the pension and insurance sector to mobilize resources, clear the pending bills for the contractors, even as they wait for payment from the government. In return, the contractors will need to forego interest accrued in return for immediate payment. The proposal, which was made during the launch of the first Sharia-compliant bond at the NSC, seeks to find alternative ways to mobilize resources for government projects away from the conventional debt that they say has become unsustainable.
We wish to advance a model which we believe will resolve this matter. Our proposed solution is modeled around the reverse factoring concept, which is a financial solution that allows suppliers or contractors to receive early payment of their invoices from a financier who purchases the invoices at a discount and offers to wait for the payment from the government. The financier stands between both parties, providing an efficient mechanism for funds flow. The suppliers will benefit from improved working capital and reduced credit risk, while this will ease the government cash flow pressure.
Further, the partners will facilitate the establishment of a fund through a privately initiated public partnership arrangement that will purchase eligible invoices from suppliers. The fund will constitute resources from pension scheme, insurance life contracts and international investors seeking to diversify their portfolios in the market and increase their return. According to CPF Group CEO Jose Aquilo, the fund can be established under the Special Purpose Acquisition Vehicles Park Regulation under the Capital Market Authorities Act.
To make this attractive to investors in the fund, suppliers and contractors will be required to take a haircut, possibly up to 30%, as well as forfeiting the default interest they are entitled to under the contracts for delayed payments to be used as a payment for the financiers.
Should the proposal sail through, the suppliers will receive their payment from the central bank, with the government being required to provide an irrevocable standing order against revenues, assuring investors that their 100% payment of receivables will be made at the agreed terms and within the agreed period. This will be achieved by creating a fast charge on the County Revenue Fund (CRF) and the Consolidated Fund to prioritize payment of the installments to the financiers. Jimmy Mbogo, Citizen TV, Nairobi.